Hi everybody, Andreas here. In today's podcast, we will go over the concept of expectation theory, providing some base case examples on how it impacts countries' currency exchange values. Expectations of future changes in central banks' policy is one of the main factors moving the currency market. Not only the actual delivery of rate hikes from central bank, but also the expectation of how much the market prices in the rate hike also matters. Actually, the currency market does not wait for the actual decision to take place. They move on to the expectation that certain decision will be reached. For example, let's assume that you have $1 million to save. In Australia, the interest rate of deposits is 2%, while in the Eurozone is 0.5%. The question arises, where do you save the money? Where is it more beneficial to park your money? Obviously in Australia. Why is that? Because the money you will put in the bank in Australia will be generating more income due to the higher interest rates compared to the Eurozone. The bank's lending rate in Australia is 2%, while in Eurozone is 0.5%. It's a no-brainer. Now, let's assume that you expect the Royal Bank of Australia to cut interest rates by 2% by the end of the year. All of a sudden, Eurozone becomes far more attractive. Now, let's assume that you expect the Royal Bank of Australia to cut interest rates by 2% by the end of the year. All of a sudden, Eurozone becomes far more attractive because if interest rates of Australia go to zero and Europe provides 0.5%, you will nonetheless get something, that something being the 0.5%, rather than nothing by migrating your money to Eurozone. Again, no-brainer here. If now investors are convinced that Australia will cut interest rates to zero, will they actually wait after the cut happens in order to move their money out? History says probably not. If investors are convinced that it will happen, they are likely to move their money out beforehand and avoid any losses. That will most likely result in the weakening of the Australian dollar without anything having happened yet. Hence, expectations matter. The market tends to price in decisions such as the one mentioned above in anticipation of the event. Another example where we can see expectation theory play out is in stocks. Let's again create a hypothetical scenario and assume that you own Netflix stock, which is currently worth $240 per share. There are rumors circulating the market that Netflix is under significant pressure and it could go bankrupt next month. The question is, do you actually wait until the company closes down or do you get rid of the stock? In other words, do you sell the stock right now? The rational approach will be to close your position now and realize your profit or loss depending on your entry point and sit in cash, avoiding the complete loss of your position as the stock will be worthless in a month's time. So, you sell now since the stock still has value. But a problem arises when enough people think alike and sell the Netflix stock at the same time. That could cause the price of the stock to collapse and the company probably may close down even faster. That's what we call a self-fulfilling prophecy. Another example we can observe expectations theory play out is in regards to economic data. Let's say that Eurozone's GDP rate for quarter 4 is to be released. Now, in quarter 3, growth was reported at around 0.5%. For quarter 4, the forecast is expected to accelerate to 0.7%. The question here is, what will happen to Euro USD if growth for quarter 4 is reported as 0.9%? Probably the pair will move higher because growth in the Eurozone was 0.9% for quarter 4, which is higher than the expectation of 0.7% for the same quarter, as well as the 0.5% rate which was recorded in the previous quarter. Essentially what that means is that the economy in the Eurozone grew at a faster pace than expected in the past quarter, thus it could cause the euro to appreciate and therefore Euro USD will rise, as practically investors would have to adjust their expectations and price in the fact that the Eurozone grew by more than what they expected. What should happen to Euro USD if GDP for quarter 4 comes out at 0.4%? In other words, lower than 0.7% expectation for the same quarter, as well as 0.5% for the previous quarter. Probably Euro USD will decline as investors realize the economy did not perform as well as expected, therefore that will lead to the readjustment of their positions and the sale of the euro. Continuing on from the previous example, what will happen to Euro USD if the GDP for quarter 4 comes at 0.5%? Again, Euro USD will most likely fall because despite the fact that the rate was 0.5% for quarter 4 being equal to the rate of the previous quarter, it is still lower than what the market expected, i.e. for 0.7% for this quarter. The market had already priced in that the rate will go up to 0.7%, but it didn't, again leading to the selling of the euro, readjusting their positions. In other words, Eurozone didn't grow as much as expected, therefore an adjustment is due. Lastly, what will happen to Euro USD if the GDP for quarter 4 comes out at 0.7% as it is widely expected? In other words, the actual rate meets the market's expectations. In theory, nothing much as the result was expected. The market has already priced in the rate, it had already positioned itself for such a scenario to actually happen, and it did. Hence, no volatile movements are expected. Generally speaking, sharp movements in the forex markets occur on big surprises. If everybody expects something to happen, they position themselves before the event, and should the event play out as expected, very little can happen during and afterwards in terms of market action. But if very few expect something to happen, and it does, we usually observe sharp moves in the following minutes, hours, days, as the market is caught by surprise and investors rush to reevaluate their views and reposition themselves accordingly. A classic example would be Brexit. At the day of the vote, the largest portion of the market expected the UK to vote in favour of staying in the Eurozone. They didn't. That caused a market surprise and the devaluation of the pound overnight as the market expectations were not met. This brings us to the end of today's podcast, where we went over the concept of expectation theory and its impact on currency exchange values. Thanks for listening. Stay tuned.